Zoetis stock has fallen by 52% from its all-time high, while their revenue has grown at a 10-year annualized rate of 6.9%. And better still, Zoetis is trading at a trailing PE ratio of just 20.4, which is a significant discount compared to their 5-year average PE of 38.5. But is the market mispricing Zoetis stock, or are there valid risks worth avoiding? Today's video will be an in-depth analysis of Zoetis stock, covering business operations, fundamental, and technical analysis. Zoetis is a multinational animal pharmaceutical company that was originally a business unit of Pfizer up until 2012 when they became a standalone entity. Zoetis is now the largest animal pharma company in the world by revenue, followed by Merck and Boehringer Ingelheim. By geography, Zoetis generates the majority of their revenue from the United States, coming in at 55% of revenue. Beyond the United States, they operate in Europe, Asia, and South America, being well diversified across multiple countries outside of the US. Zoetis categorizes their revenue in a few ways, one of which is by animal type, being either livestock or companion animal, with companion animal making up the majority of revenue by a long shot, coming in at 68%, leaving 32% of revenue coming from the livestock segment. In terms of segment growth, companion animal is by far their fastest growing segment, with a revenue growth rate of 20.7% from 2022 to 2024. While their livestock segment is growing quite slowly, by a rate of only 3.8% over the same time frame. Now let's cover the macro level pros of Zoetis' business. The first pro is that Zoetis is class leading in terms of market scale, having the highest revenue of any animal pharma company globally, which means that their research and development budget is also large compared to their competition, which is all important in the pharma industry, as R&D is what drives new medicine development and the future revenue and profits of the company. Another function of Zoetis' market scale is that they can acquire smaller companies, which they have been doing with all these recent acquisitions, making them an even larger company. Another benefit to Zoetis that is likely partly a function of scale is that they have a high operating margin, currently at 38% as of the trailing 12 months. And better yet, their operating margin has been increasing consistently over the past decade. This high operating margin is also due to the fact that pharmaceutical products are a form of intellectual property, and they're relatively small and easy to distribute. The last major benefit to Zoetis' business is that they are well diversified in terms of the types of products they produce, with their largest therapeutic category of their business, parasiticides, only representing 24% of their total revenue, with the rest of revenue being spread out across all these other therapeutic segments. Another way their revenue is diversified is by region. Outside of the US, no single country represents an outsized proportion of their revenue, and this means they can further grow into each of the markets that they're already in. Having revenue from abroad is also a hedge against the trend of de-dollarization. Despite Zoetis offering some high-level business advantages, there are some serious risks to consider. The most prominent in Zoetis' case being that 55% of their revenue comes from just 10 products. And of those 10 products, 5 products represent 41% of revenue. So they're quite dependent on these top 5 products that will eventually lose patent protection, which will lead to a dramatic decline in revenue, like it has in the past for their products, with Rimadyl and Draxxin having a 40% and 49% decline in revenue since patent expiration for these two medicines. Although, as far as pharma companies go, 10 products representing 55% of revenue isn't too terribly concentrated. Some companies like Merck, for example, have 46% of revenue coming from a single product, so the risk of concentration is relative in the pharma space. Another risk to Zoetis and all pharma companies is product liability. Each product Zoetis creates runs the risk of causing adverse side effects that Zoetis could be held liable for, although this risk is lower in terms of lawsuit settlement costs in animals as compared to humans, so that could be seen as a benefit to animal pharma over human pharma. Since 2015, Zoetis' revenue has grown consistently and fairly quickly at a 10-year annualized rate of 6.9%, although their recent revenue growth over the past 4 quarters has slowed significantly. And as of the most recent quarter, it has only grown by 1% compared to the same quarter last year, indicating some current challenges. In terms of free cash flow per share, Zoetis' results have been consistent and growing quickly, with an amazing CAGR over this period of 19.1%. The next metric we have is shares outstanding, which to me is a general indication of financial wellness. Zoetis is doing fairly well here, having reduced their share count by an annualized rate of 1.0%, over the decade, and the trend looks to be continuing recently as well. In terms of liabilities, they have a current total liabilities level of $9.8 billion, which has remained around this level for the past 5 years, which is great to see considering so many companies grow their liabilities every year. And if we take their $9.8 billion in liabilities and add back their cash on hand at $2.1 billion, their true liability level is at $7.7 billion, which is only 2.9 times their trailing 12 months net income, which is quite low for any company and shows sound balance sheet management. In terms of valuation, Zoetis is trading at a fairly attractive multiple, at a trailing price to cash flow of 18.3 times, which is a 49% discount compared to their own 5-year average of 35.6. Or if you look at the trailing PE ratio currently at 20.4 compared to the pharma ETF PPH at a PE of 20.6, Zoetis is just barely trading at a discount compared to its peer group, indicating the pharma sector looks to be discounted as well. In terms of Zoetis' dividend metrics, Zoetis offers a current dividend yield of 1.7%, which is quite low but relatively high compared to their own yield over the past 10 years, which has never been this high over this entire period, which indicates relative value and that the market has revalued Zoetis. This graph of the dividend yield over a 10-year period is a feature that I love about Seeking Alpha. And if you like it too, I have a link in the description that will get you 20% off the premium price, which is about as discounted as Seeking Alpha ever gets. In terms of dividend growth, their dividend has grown rapidly at a 10-year CAGR of 18%, a 5-year CAGR of 20.1%, and a still fantastic 1-year growth rate of 15.6%. And they have a dividend growth streak of 11 years. This growth streak and rapid growth looks like it could continue based on the dividend payout ratio, with a trailing 12-month payout ratio of only 39% based on free cash flow, and an average payout ratio over the past decade of just 31%. So Zoetis is certainly a dividend growth stock. Here we see a 10-year price chart for Zoetis, and the first aspect of the chart to notice is the price in relation to the standard deviation channel, shown here with these yellow channel lines, with the center yellow line representing the average price, and the current price being far below average, indicating serious value to be had, with the current price being 41% below the average. In terms of support and resistance, price recently broke a long-standing support level around $140 and has begun to consolidate around $120, finding stability at a seemingly insignificant support level, while what I consider as a more true support level is slightly lower around $110. Lastly, we have the Relative Strength Index, or RSI, graphed at the bottom of the chart, which shows current value and potential for upside, with the white line being at the bottom of the channel, at a level of 34.8, and even better, this is a 10-year low for Zoetis. That's all for today's video. If you want to see another video of a company trading at a wildly undervalued level, check out this video covering Adobe stock.
I'm not a financial advisor, and this is not financial advice. This is for educational and entertainment purposes.